good morning all. Thank you for joining on the Saturday morning. So just a quick disclaimer before starting the webinar that whatever the stock ideas that me and my colleague will be discussing, so it's just for the educational purpose and do your own research before investing on those ideas. So again, it's very important, right? So as an investor, what sort of quality of portfolio you would like to have. So typically in the last 18 months, right, just after the Russia-Ukraine war, what we have seen was that the value as a style has been doing really well. Okay. And the quality is not performing that much, right? And the reason was very simple that we were in a high interest rate environment. And whenever there is a high interest rate environment, so value companies where the dividend yield is high, the valuations are kind of lower, right? So those companies tend to perform well, and the companies where most of the returns are attributed to the future earnings growth, so those companies typically tend to perform typically tend to underperform than the value counterparts. So what we have seen recently in the last 1 year, that the quality and growth companies have underperformed than the neither quality nor growth. But if we just broaden that horizon and we look at the 10-year growth, like both the quality and the non-quality part of it, so the quality part of the portfolio clearly outperform the non-quality part of it. So that's a trigger for us to know that, going forward, if there is a change in the style, the quality makes a comeback, then obviously, the majority of the return will be dominated by the quality portfolios. Now, Prabhu, if you can just move to the next slide, please. So this again, case in points, present the same picture that how on a specific year the quality versus value has played out. So there are two parts to it when an investor has to do the allocation. First, whether they want to allocate across the large caps, mid caps, and small caps. So typically in a year when the mid and small caps have done relatively well, just like it has done in the last 3 years, investors try to find the argument that the markets are kind of expensive and then we have to do some profit booking, and then we can shift the investments to the large cap side of it, which is very fair argument, right? So something which has not gone up and it's kind of it has not delivered that much return, so the possibility is that in a phase of correction it will not go down that much also, and there is slightly margin of safety there. But again, there is another compelling argument which comes from the style of investing, right? So if we just try to bucket all the companies into two side of it, quality or value, so what we have seen in the last 3 years, the value companies have done really well. Okay. So for example, 22, 22, 21, 22, and 23 were the years in which the value clearly dominated the growth companies. But post election, what we are seeing is that the growth has started to make a comeback. Okay. And if growth style comebacks into the picture, then all those companies which are slated for higher growth, then these companies, the quality companies, will again set to make more returns there. So we have seen that happening in the last 6-7 months as well, when on a month basis the quality part of it is outperforming the value part. So that's a simple argument that going forward, if you have to bet, if you have to find the ideas, try to go for the quality and the growth oriented companies, as the value has already played its part and there is a very little scope for value companies to re-rate from here. And since value being value, the potential of the earnings growth will be lower. And since we are entering into a phase where the interest rate cut will be there, probably if you can just move to the next slide, please. So since we are entering into a phase where the interest rate cut would be there, so typically interest rate cut is supportive of the growth companies, as the majority of the intrinsic value is coming from the future earnings growth. The discounting will happen at a lower interest, lower cost of equity or the lowest risk, lower risk premium. So those companies are typically stand to benefit in the case of interest rate cut. So this is a typical sort of scenario that if a company today in the market is, let's say the cost of equity is around 12% and the fair value of the security is 100 rupees, even if there is a 3% interest rate cut and the equity risk premium or the cost of equity goes up by 3% to 9%, then the same 100 rupees security is fairly valued at around 182 rupees as well. So it does nothing but just increase the multiple for the stock from 1x to, let's say, 1.8x in a case of interest rate cut. So that's why we are quite bullish about the quality and the growth part of it. And majority of the companies in the Indian market where the high growth is are typically found in the small and mid cap domain. So that's why we have typically created a portfolio over the last 3-4 years, which is more quality and more growth oriented nature, that my colleague Vijay will discuss with you in detail in the next section of the slide. So over to you, Vijay, now. Thank you.
Yeah, thank you, Prabhat. Now we will move on to the next section where we focus on the multi-bagger things. But before we identify and talk about the multi-bagger things, we will need to understand what will be the pillars of the next bull cycle. So what we have done is we have categorized three main pillars coming from various sides. The first is the rise in manufacturing activity. So as we know, like government of India has been lot of vocal and pushing the manufacturing side, and we have set an ambitious target of around 21% of GDP mark in terms of the manufacturing share. So today manufacturing share is around 17% of GDP, and government is aiming that in next 5 years, basically 2029-30, we should reach at least 21%. With this thing in mind, also on the manufacturing export side, government is focusing around $500 billion of exports by 2029. And also on the EMS manufacturing, which is the electronic manufacturing space. So we are talking about again $500 billion of manufacturing on the EMS side, which will be almost 4x. Currently, we produce electronic manufacturing goods around $115 billion as of FY24. To push this, government has announced various PLI schemes for the 14 different sectors. The exact number is around 1.97 lakh crore, and till date, government has announced around 1.46 lakh crore of PLI incentives. And it has, if we look at the number, the output which these schemes have generated, it has created almost 12.5 lakh crore, which is almost 10x of the money spent, or 9 to 10x kind of multiplier effect in terms of the production and sales volume. And also it has led to the direct and indirect job creation of around 9.5 lakh. That is a huge boost if we talk about since the launch of the PLI scheme. Second is the government capex. So if we look at the bottom chart, which captures the center's capex in the last 15 years. So this year there was an 11% hike in the center's budget, almost 11.1 lakh crore. So we continue to see that it will be moving towards, let's say, a 12 to 14% growth rate in next 5 years as well. And we expect the GDP ratio, which is around 3.4% of capex as a percentage of GDP, to stay around 3.4 to 3.6% in the next 5 years as well. And if we look at the short term, so because of the election in the first half of the year, we have seen that only 4.2 lakh crore was spent out of the 11.1 lakh crore budgeted for the whole year. So if we look at only 37.8% is spent, remaining 60 to 63% will be spent in the H2. So in medium term to short term, we see accelerated expansion in terms of capex from the government side. So that will again act as a boost for the Indian economy. Third is the credit growth. So we know that credit plays a pivotal role when it comes to any economy's growth journey in the long term. And with this thing in mind, like recently RBI also reduced the CRR by 50 basis points in the two tranches. So now additional liquidity of 1.16 lakh crore has been infused in the market, which is again helpful for the banks, which will again boost their profitability, net interest margin, and also will be helpful for the new loan borrowers. And we understand like inflation has been on the higher side since the Ukraine war, but now the inflation has started to showing symptoms of cool down, and we expect in the next couple of let's say meetings of RBI's, we can expect some kind of rate cut, and in long term, let's say 2 years, we see at least 50 basis points to 100 basis points of rate cut on the conservative stance. So that will again push the terminal value of the stock prices. Also, it will lead to the lower interest burden for the corporate companies, corporates. So that will also boost their profitability because interest expense has gone down. So PAT or PBT will automatically go up. And it will also increase the loan burden for the retail people of the India. So that is again long-term growth driver when it comes to the economy. So these are the three pillars that we have identified for the upcoming bull cycle. And now we will move on to the themes which can bank on these pillars and create huge wealth for this Indian domestic stock market side. So we have identified six themes. The first theme is the consumer discretionary that we will discuss. So recently, like we conducted a research on the side. Like currently, we are at $2,500 GDP per capita mark, and because of the various initiatives taken by the Indian government, this GDP per capita will move to $3,000, $4,000, $5,000 mark. And with this, the high disposable income in the hands of people will also go up. So once the necessities of people have been satisfied, the additional income which is generated will be spent towards the discretionary items. So if we talk in terms of number, so discretionary consumption is set to go up by 1.3x versus the overall consumption. So the overall consumption is expected to go up by 9.5% CAGR in the next 10 years, but the discretionary consumption is set to go up by 12.5 to 13% on the overall market industry level. So that is a huge like multiplier effect versus the ordinary kind of consumption, and the necessity consumption is set to grow only at 6.5%. It's almost double if we talk about the consumer discretionary space side, so which is a huge growth driver in terms of the 12.5% if we look at from the next 10-year perspective. Second is the building material. So with the rise in disposable income, people feel more confident about taking loan and buying a housing space, or let's say housing versus renting out the space. And because of the this highly disposable income and the rise in purchasing power, people tend to borrow from the banks and NBFCs, and we see the additional boom on the housing side as well. This also leads to the boom in the building material space. Third is the wealth management, which is again a sub part of finance as a whole sector. So currently, if we talk about India, the penetration of wealth management is only 15%. And if we look at the developed economies, especially from the US or the Europe side, the penetration is more than 75 to 80%. Of course, we are a developing economy, so we have a long way to cover from 15% to 75%. But in the upcoming decade, at least we expect by 2035, this gap should bridge, and we should be at least at the 30% penetration mark, because the wealth management need is also growing because of the high disposable income. Fourth theme is the renewable energy theme that we call the RE in short form. So again, we need to understand India is going under the energy shift in this last 5 years, and if we talk about the next 5 years as well. So we have created around 180 gigawatt of renewable energy capacity in India, out of which the major is the solar, 72 gigawatt. And government is focusing like with the ambitious target of reaching 500 gigawatt on the overall level by 2030. So it's almost 3.3x kind of jump in the capacity, which will come online in the next 6 years. If we look at the solar, which is 72 gigawatt today in installed capacity, it will move up to almost 280 gigawatt, which is the 4x in terms of the energy capacity, which will be the largest beneficiary in terms of the solar, wind, and hydro. So solar will be the largest beneficiary. So again, we are bullish on that. The fifth and sixth thing, which is the manufacturing capital goods, that we have discussed in the previous section as well, like government's focus on the to increase the market share of manufacturing as percentage of GDP from 17 to 21. It will be a natural tailwind for the any manufacturing company. Again, the capex revival, which is growing at 11 to 12% for the next 4 to 5 years as well, will lead to the push in the capital goods space as well. So these are the 6 dominating themes which we think will lead to the new multi-baggers in the next 5 years. If we talk about the key risk that we think in our research framework, that there are the 3 sources of risk that we need to monitor. So first can be the earnings slowdown, which we saw in the Q2 of this year. But we are not. It's not a permanent one. It's a more of a event-related slowdown. So we are not much concerned about it. Second is geopolitical tensions and some development on the global side. So we need to be watchful of that. And the third is the inflation spike because of any commodity or war-related issue. So these are the 3 risks that we are actively tracking at, and based on that, we will also take the necessary action in due course of time. So now we have this 6 space or 6 sectors. Now we'll spend time like how we can identify different businesses from this space, which will help us to deliver superior risk-adjusted return in long term. So we can move to the next slide. Yeah. So in this section, we will discuss how we have developed the multi-bagger framework in the last 5 years at the right horizon, and we have combined the risk and return both part of it. So this framework has basically 2 legs. First is growth, second is value. We will discuss the growth part first. So typically in growth part, we look for a business in our portfolio which can double its earning over 3 to 5 years of period. So let's say if we take example of paint industry and it is growing at, let's say, 15%, in that industry, let's say the leader is growing at around 16-17%. So we'll go for we will try to identify a company which can grow at a 20%, which will be almost 1.2x of the leader and 1.3x of the industry. So if we compound, it can compound its earning for 20%. If we raise it to the power of 4, so in 4 years, it will double the earning. So we look for such kind of businesses. So when we identify such businesses, then we deep dive into the particular business model. So what we look when we study the business model is two things. First is quantity of growth, which is the absolute amount, which is a 20% or 25%. It can grow for the next 4 years or 5 years. And second part is quality of growth. So quality of growth, it's broken down again in two segments, which is the sustainability of growth, that how sustainable the growth is, and second part is the longevity of growth, that how for how long the company can grow at an abnormal pace, let's say 1.3x or 1.5x of the industry growth. So these are the two parts that we look in terms of the quality. Also, when we talk about the business, so we also meet the management and we try to understand two sources of risk, basically from the promoter side. First is the business risk, which comes from the, let's say, the uneven volatility in the, let's say, raw material prices, or the profitability going down, or the EBITDA margin, which is not sustainable, or any cyclical part in the overall business model. So that we try to identify and nullify it. Second is the corporate governance risk. So we also try to understand from the management how they are doing walk the talk kind of thing, whether they are delivering on the promises, whether they are candid about their mistakes and failures. So we are not shy of the mistakes that the management commit. We know that they are also humans like us, and they are prone to do mistakes. But we look at the approach, that how they are handling the mistakes and how they are transparent about it, which kind of disclosure they are doing, and how they are minority shareholder friendly, because in the end we are the minority shareholder. So we need to understand how which kind of treatment they give to the minority shareholder. So these are the two sources of risk that we look while we study the business model. Second leg, which covers about the valuation. So we typically don't buy company which is overvalued. We'll always look for a business which is trading below its fair value. So let's take example of, let's say, retail space, which is trading at a E by EBITDA multiple of 45x. So we look for the business which is trading at, let's say, 22 or 20 kind of E by EBITDA multiple. So we have almost 2x upside if the multiple goes from 22 to 45. So once the stock discovery happens, the EPS goes up, and in next 4 to 4 years, we can assume, or we can expect, like this 22 multiple, which is currently trading in the market for the company, it can rise up to, let's say, 40 to 45x. So if we combine the two part, let's say the growth of EPS, which is 2x in 4 to 5 years, and if we see the multiple expanding from 22 to, let's say, 45, 44, again it's a 2x, so 2 into 2, it becomes 4x. So any business that we pick from this multi-bagger framework is we are targeting around 4x kind of a return from a particular space. Again, this framework does not like guarantee the absolute return. What we are trying to discuss is only for the educational and indicative purpose, and just for a disclosure purpose. And we identify around 25 to 30 different businesses from various space to diversify the unsystematic risk. And we, let's say, even in the worst case, let's say 20% of the thesis don't go as per our plan in the next 4 to 5 years, 80% of companies will still end up delivering at least double of earnings, and let's say the upside of at least 2x kind of valuation re-rating. So it will lead to the healthy, let's say 3x kind of healthy growth in the portfolio side. Again, it's an indicative number and for the only education purpose. So that is how the multi-bagger framework combines risk and return both. Now we will look at the outcome of this framework that we have developed and again used on the last bull cycle, and also we have applied in the current bull cycle as well. So these are some of the examples from the past bull cycle of FY19 to 22. So one of the winner for our space was the IRCTC coming from the railway side. So we had entered around 35x P and we exited around 105x P. The market cap was around 16,000 crore at that time, with more than 50% core OC, and the working capital cycle of hardly 72 hours, because it's basically a online business and clearing happens very fast. So we picked these businesses with the strong moats and the strong monopoly with the 90% market share, and we're expecting the earnings to go up around 2x in the next 4 to 5 years. But in the short period of time after the COVID, because of the discovery of the street, the P expanded very quickly from 35 to 105x, almost 3x re-rating, and earnings went up by 2x in first 2 years only. And we end up generating around 6x for that particular company. Of course, we try to trim down at every point of rise in the IRCTC, but this is the maximum gain that we captured from the highest to bottom point. Similarly, there were various winners for us like Neogen Chemicals from the chemical specialty chemical space, KEI, Dixon, APL Appliatives, and GMM Fodler. So these were the different businesses from different segments. If we extend the list a little bit for the general purpose, please move on to the next one. So this is the extended list. So in the last 5 years of our operations in terms of research on SMIT side, we have identified more than 25 businesses which have turned multi-bagger for us. And the key thing to note is that majority of return has come from the valuation upside, which we have seen in the past slide as well, like 3x for IRCTC. Earnings growth has been mostly in the range of 2x to 2.5x. But our early discovery of a particular business, which is our key criteria, or let's say the key speciality when it comes to identifying the business as early trend, has helped us to deliver massive multi-bagger returns for our investors. So if we look at the, let's say, the power space, we have the REC, contract manufacturing, Dixon, specialty chemical, IT being Apple, paints being the Sirka paints, and also on the NBFC side, we were able to identify Ugrocap. And again, there were multiple names from the dental space and also some specialized niche species. So this is how we have been this is the result of the multi-bagger process that we have developed, and we will discuss one live case study to help understand how we are applying it in the recent time as well. So this company or the business that we will discuss is Sky Gold. So basically, it's a B2B jewelry manufacturing company. So basically, it does the contract manufacturing for the players like Malabar, Joy Lucas, Kalyan, or Senko as well. Recently, they onboarded two new players. I will discuss in a bit. So we met this management somewhere in the first quarter this year, and they explained us how they are trying to, let's say, expand their manufacturing capacity from 250 ton per month to almost 750 ton at that time, and how they are planning to use the capital that they are planning to raise in the future. So they recently raised 270 crore the QIP route. And interestingly, they also acquired additional capacity of 250 ton per month through two acquisitions. And now the whole capacity stands around 1050 tons, like kg per month kind of thing. And if we look at the, let's say, expansion in terms of capacity, it's almost 4x. So it used to be 225, now it's on almost 1050. So it's a huge boost, almost 4x capacity expansion happening for this business. And at that time, they had disclosed that we are also trying to tap in the large clients. And we are happy to announce that they had also got two new players. First is the Titan, from where the Carrot Lane are also tied up with the Sky Gold, and they are going to place orders on the recurring basis to this business. Second is the PNG, which recently gone through the IPO. They have also tied up with the Sky Gold. So now Sky Gold is like ready to use the capacity expansion that they have done from almost 225 kg per month to almost 1050 kg per month. And the company has again set an ambitious target of 6300 crore by FY27. So when we identified, the PAT was trailing 12 months was around 40 crore. It is almost 81 crore as of now, and the trailing 12 month sale is around 2400 crore. And if we look at the 6300 crore mark, it's almost again 2.5x upside in the next 3 years. So the entry price for our like in our portfolio was around 1125 on the lowest side. CMP is around 440.31. Of course, it made height of around 4600. So we are almost 4x in this business. It happened almost in the last 10 months. If we talk about 2x earnings growth and 2x kind of multiple rating, and this is how we generated around 4x return. Again, this business discussion that we are doing is only for educational purpose, and you can do your own research before making any decision on the particular business. So this is how, like, our multi-bagger framework also helped us to identify the future multi-baggers before, in the present time, before they actually unfold in the next 4 to 5 years. And the efforts that we have put to identify such businesses and spending time with the promoters and understanding the balance sheet and understanding the moat of the business has helped us to deliver strong risk-adjusted returns. And since we have taken over this fund and actively started managing it, so the fund has delivered almost 35% CAGR, and versus the index CAGR of around 22%. Again, one more point we would like to highlight is we don't pick businesses which are cyclical in nature. So we may underperform during the PSU unlocking, or let's say the value cycle being played out, but we will outperform in the longer run because we believe in the strong earnings growth. And as my colleague also disclosed, discussed, like in long term quality of growth and the fundamentals drive the stock price return, not the inflows or outflows of the particular time. So that is how we have developed this fund, and we are positioning in that manner. In the short period of time of 6 months and 1 year, the fund has performed very well. And the 1 crore invested in fund from November 20, which is almost 4 years back now, has almost gone up to 3.2 crore on the aggregate basis. Of course, the model portfolio return will be again higher, 4% CAGR. So model portfolio will be somewhere around 38% CAGR versus the 34 of aggregate, and versus the index of 2.2 crore. So in a nutshell, we strongly believe in the India growth story, and we believe like the SMID space remains the best to play this multi-decadal wealth creation journey. If anyone wants to be part of this journey with us, please feel free to join us in this journey. But with this, we conclude this session. Thank you everyone for listening us patiently. Yeah, we can move on to the next section. Prabhu. So before we begin the Q&A session, we have a small announcement to make. Prabhat, would you like to take this over?
Yeah, Vijay. Yes. Just give me.
Yeah.
Yeah. So, we have reopened the scheme Super Value Aggressive again for the further subscription. So, just to give a quick background of it, we launched Super Value Aggressive in March 2023 when the valuations were quite beaten down, and we have spent quite close to 1 year like discussing the ideas and researching the ideas from the small and mid cap side. So we felt that at that point of time the valuations were quite lucrative. So we opened the scheme Super Value Aggressive, which is again an aggressive version of the Super Value scheme. So after 7 8 months, around October November last year, we felt that the valuations have rallied and there is no point in taking fresh inflows in the scheme. So we have stopped the fresh inflows in the scheme and we have closed for the further subscription. Now in the recent correction, what we have felt that the stock price is down 10% from their all-time highs, or like the portfolio is down 10% from the peak NAV, while the quarter two earnings for the portfolio companies are very robust. The quarter two earnings for the index is roughly in the range of 5 to 7%, but the quarter two earnings for the super value aggressive portfolio is in excess of 25%. And that gave us the confidence that even in the weaker sort of environment, the quality companies can tend to do very well and can generate very sort of high earnings growth for the investors. So that was the reason that now we see that the valuation is down around 15% from the peak. We can open the scheme again for the subscription for the customers. So that's why we have reopened the scheme on the 17th or 18th of November. Until that, if you look at after reopening the scheme has delivered close to 12% return, while the index is only up 6%. So the main idea is that although we are investing in the small and micro cap names, we tend to underperform, we tend to outperform when there is a market correction. So our portfolio typically falls lesser than the market whenever there is a market correction, and we do it by systematically onboarding companies where the focus is on fundamentals, focus is on earnings growth, and then we have a wide tail of stocks where the future multi-baggers will come, as Vijay has highlighted, right? So that's how we run the portfolio. So we don't see any sort of material risk here. And in fact, we are very comfortable with the valuations. So that's why we have reopened the scheme again for the subscription. But in a very short span of time, since 17th or 18th of November, we have seen the one-way rally again in the small caps. So we are going to close the fund again for the subscription on 20th of December. So we thought 1 month is enough time frame to go for the fresh inflows. Till we have the time where the valuations are kind of reasonable, and once we see that the valuations are again rallying ahead or racing ahead of the fundamentals, there is no point of taking fresh inflows again into the scheme. So we'll again stop the fresh subscription into the scheme on 20th of December. And the end goal of this scheme is to return the investments back to the investors whenever we feel that the cycle of the small caps or the mid and small caps is near to the peak. So with that objective, we have opened the super value scheme again, aggressive scheme again for the subscription. So if someone is interested, in knowing more about it, they can get in touch with the RM team, and we'll taking them through that.